Welcome to The Explainer. Today, we're going to get into the weeds and break down the anatomy of a trade. There's this one stock that's been making a lot of noise, and we're going to walk through a trader's entire thought process to figure out if there's a real play here or if it's all just hype. So check this out. It all kicked off with this one number, 109 million. That's how many shares of stock BYND were traded in a single day. I mean, that's a massive, massive surge in volume that basically puts a giant flashing light on it for every trader out there. And, when you see that kind of volume, and then you see an 11% price jump to go with it, traders all start asking the same exact question. Are we looking at the beginning of a short squeeze here? All right, so here's our game plan. First, we're going to look at why this thing is getting so much hype. Then we'll look at the big argument against the stock, followed by the hopeful signs for it. After that, we'll dive into the specific strategy and, of course, land on the final verdict. Okay, so what is all the fuss about? Let's dig into why everyone's suddenly paying so much attention to this one particular stock. The whole buzz, the excitement, it's all about something called a short squeeze. Now, in simple terms, this is when all the people betting for the stock to go down get caught in a major trap. They have to rush to buy shares to stop their losses, and that buying, well, it just pushes the price up even faster. It can be like strapping a rocket to the stock. But hold on, before we get carried away with rocket ships, a smart trader always hits the brakes and looks at the biggest roadblock. And in this case, it's a big one. This stock has a long, painful history of just going down. The main villain in this story is a technical indicator called the EMA 200. The easiest way to think about it is like the stock's long-term center of gravity. And for years, this stock's price has been trapped under its powerful downward pull. This indicator really tells that story. For years, that EMA 200 line has been like a heavy concrete ceiling. You can see it right here. The price gets some momentum, it tries to punch through, and bam! It gets slammed right back down. Again, and again, and again. It's just a powerful, consistent pattern of rejection. And this really gets to the heart of the bear case, summed up perfectly by the trader's analysis here. History shows that until this long-term downtrend is well and truly broken, any little pop in price is probably just going to get smacked down by other traders betting against it. But that gloomy history, it isn't the whole story. Now we get to flip the coin and look at the other side of the argument, the hopeful little signals that are suggesting, hey, maybe this time is different. And this is where things get really, really interesting. It's all about perspective. See, on that long-term daily chart, the EMA 200 is that nasty ceiling. But if you zoom way in to a shorter 1-hour chart, the whole picture has flipped. Suddenly, that same indicator is acting like a supportive floor underneath the price. So the trader starts putting the bullish puzzle pieces together. You've got that massive volume we talked about. You've got a strong support level, a double bottom, where the price refused to go lower. You're starting to see a classic pattern of higher lows, and then you have that crucial trend flip on the short-term chart. Altogether, these are pretty strong clues that the momentum might finally be shifting. So what do? You have this long-term bear case fighting a new short-term bull case. How does a trader even navigate that? Well, you do it with a very, very specific game plan. Now, this is absolutely crucial. This plan isn't just a hopeful bet. It has a built-in safety net, an eject button called a stop loss. It's a preset price where you say, okay, I was wrong, and you get out of the trade automatically. It's your protection from a bad situation turning into a disaster. So here it is, the whole strategy laid out nice and clear. You get in around the current price. Your first target for taking profits is a roughly 20% gain. The absolute best case scenario, a 130% gain. But here's the most important part. The stop loss is set for a maximum potential loss of only about 8%. And if you're a visual person, this chart just says it all. The whole plan boils down to this simple idea of asymmetrical risk. You're risking this small, defined amount, that 8%, for the chance at a much, much bigger gain of 20% or even more. And that right there is the heart of a calculated trade. So after weighing the bear case, the bull case, and putting together this super specific plan, what's the final call? Let's get to the verdict. The conclusion is bullish, but, and this is a really big but, it's cautiously bullish. The idea is that the stock looks like it's in the very early stages of a potential turnaround. This makes it a short-term trade based on these new patterns, not some long-term bet the farm investment. The real lesson here isn't just about this one stock.
It's about having a structured way to think. It's about looking at both sides, using different perspectives to spot changes early, and most of all, never ever trading without a clear plan that includes your exit strategy before you even click the buy button.
And all of this leaves us with one last question to chew on. By having a clear plan, by defining your risk, your reward, your exit, can you actually turn what looks like a hopeful gamble into a calculated trade? That's the difference this trader is betting on.